I've said many times that this is a long term process that we are in. It's taken us 20 years to get where we are financially and socially. It's going to take us 20 years to get out. So, what's the point of watching news? Well, it gives us some indication of where things are going. At this stage in the virus pandemic, there are a lot of things that we don't know exactly how it's going to come down, and analysis is ongoing. Yesterday, there was some big news that was announced that gives us some clue as to how it's going. In short, we are very much in this for the long haul. The most important thing is that the total number of virus cases hit a new high in the United States at 41,000. It looks like a second wave is forming. This is fairly understandable. A lot of places were opening up, and now Texas and Florida in particular are going to close back down. They're not going to relax the restrictions. This has always been portrayed in popular media as a choice. Do we have a lockdown that protects people's lives, or do we open things up to protect the economy? It's one or the other. This is completely ridiculous. If everybody winds up getting sick at once, the economy will suffer. All right, it's really that simple. And we've seen from how this virus progresses, yes, there's like a 2% death rate, but there are many more people who become seriously ill and are affected for the rest of their lives. And so worker productivity will decline no matter what if everybody gets sick. It's not an either or choice. We have to protect people because people are the core of the economy. Period. End of story. So that's definitely progressing for the long term. But something else came out. The Federal Reserve released the results of their comprehensive capital analysis and review, or stress test. They've been doing this fairly often. It's usually just an annual event, but they did one in February, they did one in June. Uh, it's an analysis of banks. How are they doing? Uh, they call it a stress test because, well, the concern is that we might have a coronary and everything might latch up. And it's very similar to that kind of thing. How are banks doing? Well, there was some good news. Capital, generally speaking, banks, and they went down one at a time, and the banks over 10 trillion in assets. That basically banks are doing well in terms of capital. It's not a huge problem, but they also looked at a more comprehensive picture that they've been studying as things have developed. And those results aren't as good. See, capital might be fine, but there is a coming liquidity problem, which is to say the cash flow, enough cash to continue the operations. In what form? Well, they pointed to something I talked about before, which is the ongoing corporate debt problem. The amount of debt that's being taken out by corporations just to fund ordinary operations, not going directly into as capital investments. But more importantly, the Federal Reserve looked at three possible scenarios for the recession. They look at, how are we going to come out of this? And it's called a V-shaped recovery where it goes down sharply and goes back up sharply, or a U shape where it stays down for a little bit and then comes back up, or a W where it comes back up and then crashes down again and goes back up. They didn't talk about an L where it just stays down. That's just bad. We know that. But if there is going to be some kind of recovery, how's it going to do? It turns out it doesn't matter much. Okay, all of the talk about the shape of the recovery just isn't that important. What the Fed was really concerned about, and I want to read this rather directly, uh, in the three downside scenarios, the unemployment rate peaked at between 15.6 and 19.5%. That's the headline U3 unemployment. I think last time I said U4 by mistake. I'm sorry about that. Uh, the unemployment rate will peak between 15.6 and 19.5%. Now, remember, we had an unemployment rate in April of 14.7 that went down to 13.3 in May. Wow. But as I said, nobody believed that number. That includes the Federal Reserve. They don't believe it either. Okay. It's a temporary thing. It was a glitch. It didn't conform with the ADP numbers. Unemployment rate is going to continue, and this is going to affect cash flows all the way through the system. I mean, if people have trouble paying their car loans, their mortgage, their student debt, all of those kinds of things, there's less money flowing downhill. What's really important from this analysis is that what the Federal Reserve considered their sort of worst case in February was actually rather rosy when they look at it in June. Things are deteriorating very, very rapidly. And they said, look, banks, no more share buybacks at this point. They allowed dividends to continue, but there was a lot of dissent about that. They are concerned that there is just not going to be enough liquidity, enough money, cash available in the system in coming months. This is important because it means the dollar is likely to appreciate. Dollars are going to be harder to get, therefore, there's going to have to be an appreciation. And that means, of course, that, well, interest rates are going to have to continue to go down. How much lower can they go? Yeah, we're at zero, right? I mean, the European Central Bank floated the -1 interest rate for their central banks. Are we going to be considering that? They didn't say yet, but the Fed is being very transparent about the analysis that they are using to make their decisions. They didn't say what their policy will be yet, but they're telling us what they're thinking. It's not bad. More importantly, as I discussed before, we have to be concerned about the Fed's exit strategy. I mean, yes, they're buying a bunch of corporate debt, the stuff that's kind of, on the verge of being junk. But what is their exit strategy? How do they get out of it? Short answer is they don't care. They're not even close to thinking about an exit strategy. They're looking at this, they're in the middle of a crisis, okay? They're going to be buying with both hands, they're going to be doing something. We don't know exactly what yet, but it's a very dire prediction. They're going to have to be injecting a lot of liquidity into the market, and that's more than just buying back corporate debt. So, where do we really stand with respect to everything? We're in it for the long term. No one is thinking yet about how we get out of it. You can look at whatever kind of recovery you want, but it's way off in the future, and it doesn't really matter what shape it is. That's what's critical. We're going to be seeing more and more dramatic action in the coming months. Now, as part of this February analysis versus the June analysis, remember the Fed basically predicted that there would be a 50% decline in stocks, which didn't quite materialize. And of course, it took back about 80% of those gains, or of those losses, rather, and came back as gains. Look, this is not sustainable in any way whatsoever. The Federal Reserve is going to be focused on maintaining the capital portfolios of banks. It's going, but they're going to start focusing on liquidity, on cash flow. And given those kind of unemployment numbers, that's what's really the issue. How everything goes through the economy. The velocity of the dollar is already below 1, and it's only going to get worse as they inject more liquidity. Now, I talked at some length about the multiple mandates of the Federal Reserve. They're really looking at the unemployment, inflation kind of thing. Let's not worry about inflation, but they're worried about the unemployment. The foreign exchange, the dollar has to strengthen. We really have to look at what happens to renminbi and the euro versus the dollar. Meanwhile, over in China, there's a tremendous amount of rainfall falling right now. I'm watching the Three Gorges Dam, to be honest with you. We'll see how that holds up. But it's certainly disrupting everything that's going on in China while they have a big second wave pandemic outbreak in Beijing itself. Okay? So this is happening all over the world. Europe is getting by, but China is in the middle of some very, very bad stuff, and it might get significantly worse in the next week. Keep an eye on the water levels in the Yangtze River, right? Wow, as if there's not enough to watch. So how much news do we want to keep in track? I don't know. It's going to be difficult. What do I advise for your investment portfolio at this point? I mean, honestly, I'm making a big investment in, yes, canned food. We have to be ready for just about everything. And, well, if you've ever had to survive a hurricane, like Hurricane Andrew my family went through, this is what gets you through it. And that's what we have kind of going on right now. It's obvious that we're in this for the long haul, and we are still, even in June, very much at the beginning of what's going to be a multi-year process of sorting all of this out. The virus itself is coming through a second wave, and don't ever think that the choice is between people and the economy. People are the economy. And we're going to, well, we might wind up learning that the hard way. So, where are we at this point? The news tells us there's a lot more yet to come. You may not want to watch the news. And, no news is good news, right? Just don't watch it. But every once in a while, there are some things that come through that tell us where it's really going. And it wasn't that great. But we'll keep an eye on things. I'll see everybody.